my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat and Chicago corn. I'll start with Chicago wheat. The most recent activity here had been the late August break higher above the July to August upper bear channel line. In the process of moving higher, prices formed an ascending wedge pattern, currently 995 to 1033. This carried on higher until in late September the market's rise met a resistance that it could not overcome despite trying for 4 weeks. This was the important, slowly rising, long moving average, currently 943, at times coinciding with the November 2012 high at 930. This moving average was breached, but did not have 2 consecutive closes over at any point in its testing. 2 weeks ago, at the high water peak of the market, prices turned down, making a very interesting weekly key reversal down, and headed even lower, down through the lower trend line with ascending wedge pattern, making a clean break lower, with all the implications that has. The market dropped below some significant supports, but it was only last week at the slowly rising short medium moving average, currently at 860, that we have even found the beginnings of some support. There are now 2 avenues that I can see for this market, though there are no doubt more available that will eventually make themselves known. The first is the straightforward move down with potential targets for the ascending wedge pattern. Ascending wedge patterns, though, are notoriously unreliable. Thus, a primary target X on the downside was already achieved in the 860 area, whilst a secondary harder to achieve target X1 is way down below in the 712 area. This leads to the second avenue, and something that I have previously mentioned on a number of occasions. It's a possibility for the whole of the July to day action being not just a V bottom, but a V bottom with an extension. These extensions have something like a bull flag within them, and that is what may be happening being built at this time, since mid to late August. Personally, it looks a little slack as a pattern, but if the short medium moving average manages to hold the market up, which so far along with the November 2012 low at 843, it sort of is, and we then eventually see prices revert back up, well, then this second scenario, the larger V bottom with an extension, suddenly looks a lot more interesting. Chicago corn. I'd like to recap once more some of the key elements of my comments formed over the last few weeks, as they still seem very valid. The first element is the reverse head and shoulders pattern over July and early August. I was initially unhappy about this pattern, but it has turned out to be a good one, especially the neckline, currently at 694. Has been incredibly supportive since the market broke higher over it back in late August, apparently until today. The primary target for this reverse head and shoulders pattern has already been achieved, and for the moment I'll have retired the secondary harder to reach target in the 714 area. Secondly is the impact of the slowly rising long moving average, currently 690. This had earlier tried to cap the market, but as it separated from the 50% Fibonacci line of September 2021 to April 2022 move at 661, its efficacy as resistance faded, with the market moving up through it. It has recently become an indicator of the very recent bullish angle of attack and a sort of support, apparently until today so far. Finally, and most important of all, there is the July to date ascending wedge pattern, currently 751 to 713. I'd personally found this to have been the most elegant of all the elements right now, and in previous commentaries. Last week the market exited this pattern. The reason we've seen this exit from the ascending wedge pattern in the first place is because the market has been getting swished between the overhead congestion at 694 to 700, containing the neckline of the old March to June head and shoulders top, currently at 698, and the supposed support of the long moving average, plus the neckline of the reverse head and shoulders below, and importantly earlier the lower trend line of the ascending wedge pattern. This situation reached its cusp, and we are now looking to see if the market pressure to seemingly go lower will make itself evident. If it does, then a primary target X for the break below the lower trend line of the ascending wedge pattern, by the way I'm assuming it's a true break, not a false break, The lower trend line, the primary target X, would be in the 648 zone, with a secondary harder to reach target X1 in the 550 zone. There's also a possible question of a very large V bottom or bearish halfway hesitation pattern, but I think I will leave that for another time. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.